Also, while we were away, there were some surprise central bank actions coming in from Russia, which has hiked its rates by 350 basis points. And China, on the other hand, has actually cut its rates by about 15 basis points. Quite a few global concerns as well emerging. Fitch is actually warning of US bank downgrade, which is why you're seeing that sharp plunge overnight coming in on most of the US equity markets, the Dow knocking off almost 1% in the red. Fed members are advocating capital regulation on regional banks now. China developer Country Garden is on the brink of a default. So the news flow, Nikunj, from where we left it off on Monday has worsened.
See, Aisha, you're getting a divided view of the world. Yeah. China's cutting rates. Why do you cut rates? Because you expect the economy has slowed down enough and you need to stimulate it by monetary action. Russia is increasing rates because they feel that the economy is doing okay and you need to take care of inflation and other demand factors to ensure that in the near term inflation does not run away. So you are looking at a divided world, and I think post-COVID that really seems to be the factor at play. There is no universal fact where, okay, US Fed has increased rates, everybody else will increase rates. US Fed has cut rates, everybody else will cut rates. No, that is not happening. But for me, I think the global headline, I think, is that the China slowdown, China comeback, which everyone again thought, I don't know why, which everyone again thought is going to be the story of the second half of 2023 that is getting challenged. What had led to that Chinese recent data, that markets started thinking that China will open up, demand will come back, flows had started gravitating back into China, and commodity and metal prices, they had started rallying. If China has cut rates, and this is not a bull market, this is a time when they are cutting rates, when inflation is high, this means that the demand is not going to be that strong. Demand does not remain that strong, which means I see the following happening. I think commodities will peak out, especially base metal, industrial metal, steel and both ferrous and non-ferrous. B, I think the money which moved into China, I don't know why, but the money which moved into China, again, everybody would be asking that why do you want to go to China when the unlock trade has failed and when the comeback economy trade is not real. So for me, the messaging is that if the Chinese economy is getting supported by monetary action and looking at the demand scenario, it is highly unlikely that this indirectly will really benefit a market like India.
Okay, so clearly you did have a lot of those financial stocks coming under acute pressure on Wall Street, and it was a losing session with all the major indices wrapping up in the red. You've got the Asian screen as well, along with banking stocks retreating this morning. But what about the cues on Monday? Well, we wrapped up the trading session at around 19,434 levels for the index. We did see that bounce back from the lows, and that was towards the fag end of the trading day. You had the broader markets, though, that underperformed, and that was pretty evident with a wrap of about a 0.7% cut on the small cap end of the market. In fact, it was the global cues that clearly seemed to weigh down on the metal sector. We've come off from those recent highs on the Nifty Bank by close to 2,100 points and on the frontline index by nearly 550 points. And banks, Nikunj, continue to remain the weak link.
So let's look at the recent data. The bank Nifty from the recent has down by 5%. And during that same time, the Nifty has taken a knock of about 3%. Now, the bank Nifty or the banking index has been the market of choice. This is where all the overweight positioning is. This is where the market action has been the strongest. This is where the price action also has been the strongest. But of late, things are reversing. So if the leadership sector reverses, you could ask yourself why and what should one read into that. So the decline in bank Nifty, I won't say it's alarming, but it is a telltale sign of the market mood when a performing sector like the banks or financials, they start retreating. And this time around, the decline actually has been led by the most haloed and the favorite group, which is private banks, whether it's a combination of HDFC Bank or ICICI Bank or perhaps both. Meanwhile, the market also are looking slightly puffy-duffy. Nifty future premium has declined. Fresh short positions are getting added. There's nothing alarming in the market, but I see the following happening. I don't think markets are going to go up in a hurry. The bias of the market clearly is on the downside. The mid and the small cap stocks selectively, I think, are showing signs of fatigue. So it is fatigue in the financials. It's a reversal in some of the patronized trader stocks. And I think I don't you want to use the word sharp sell-off, but a sell-off in the small and the mid-cap stocks cannot be ruled out. We are not there yet. But if the direction of the market has changed, surely the internal workings of the market will also change. The headline is that the Bank Nifty, the leader index, is down.
Yeah.
that is not great news. And if the leader index is down, it clearly means that it will have its inertia, and the inertia I think will only get more and more pronounced on the downside. So the strategy is that I don't think you should still go short. It's not a breakdown, but you just want to avoid buying, avoid your commitment levels, keep your gunpowder dry, because if the global data continues the way it is, then surely this market will give you a great buying opportunity sooner than later.
Yeah, and just on the point that we were making about the divergence from the central banks, both from Russia as well as China, for us as well, we are sort of at a crossroads, and inflation clearly is resurfacing. The data seems to be suggesting the same. The fact that CPI is now at a 15-month high of 7.4%, and this is in a stark contradiction to what you saw in the month of June, which was at 4.8%, when everyone thought that inflation is a forlorn story. In fact, the July CPI print is a good 257 basis points higher than the month of June. Food inflation, as we all know, has already risen up by a staggering 11.5% in the month of July. Vegetable prices alone have seen a whopping 37.5% nearly jump up coming in the month of July. And retail inflation, that was below, of course, the 4%, which it clocked in September 2019. That's on a year-on-year comparison basis. But yeah, the bigger question mark is how longer can the central bank, for us, that is RBI, will remain in pause mode? Because if inflation does not get controlled here, then we're in for a rate hike.
See, there's the if there, and I think the if is where the variable factor is. Sometimes that like 2021 after the war, 2022 after the war, you knew that inflation would haunt you for a couple of quarters. This food inflation, tomato and other vegetable prices. Now I can argue back and say that this should cool down because we had delayed monsoon, and this time around the vegetable crop sowing is decent. So you will not ring the alarm bells, but you want to be a bit watchful. What this will do is that this surely will take all the assumptions of a rate reversal away. So you can't make a case for a rate increase, but a rate reversal is surely out of the window. Let's hope that China data, which is not looking all that encouraging, and we have crude and other prices have reversed, that it will just only have an impact on the way our commodity prices move. So at least one concern has been taken care of. I think this is more like a seasonality which is at play, and which is what Reserve Bank of India is driving comfort from, because 7% inflation, and if it appears that it could last for another 3-4 quarters also.
48 months on the chart that it's been above the RBI's comfort zone in terms of the print.
So it's mathematical, Avan. Mathematical is that it's a combination of basket, and that combination of the basket, when it moves, it will be captured. All markets are saying, and all of us are hoping that this is seasonal. Because if this is not seasonal, and if this persists for another one more quarter, then trust me, Reserve Bank of India, they will not have to use the guns. They will have to use a machine gun in this case to bring inflation down, because we are reaching that level where it's not going to be tolerated. I think the Prime Minister also made a remark that,
where he said we've imported a lot of things globally, and one of the things that we've imported is high inflation, and this is a challenge, he said.
And you're reaching elections, state elections followed by central elections. So inflation has to come down.
And food inflation, which is so consumer sensitive.
So it has to, if it does not come down, then we are in for a big sharpish move from Reserve Bank of India. But I doubt that Reserve Bank of India increasing rates, will it bring vegetable prices down? What can you do about it? There's nothing can be done. It's a factor of how the patterns have moved in terms of the vegetable sowing.
Okay, so perhaps have to bring out the heavyweight machinery if inflation isn't curbed in the upcoming, by the time we have the upcoming policy meet. All right, let's move right on. The stock in focus today is clearly going to be ITC. Two triggers. One, the fact that it came out with its numbers. It was a mixed bag. You had profits which came in above street expectations. And then, of course, the devil in the details when it came to the fine print of the demerger. They've approved that hotel biz demerger. And the entitlement ratio at 10:1, Nikunj, with a listing likely in the next 15 months.
First, the numbers. I think if you look at cigarette volumes, 7-8%, okay. They're gaining market share from the illicit market. FMCG business, I think they're impressive. When rest of the other companies who have a turnover of 20,000 crore, they've struggled. ITC has reported a margin expansion. See, frankly, if I look at the total top line, the top line was difficult to assume. Why? Because there were ban on agri exports, and it's a judgment call that how much ban would have impacted for the quarter gone by. But that's the reason why the top line, in a sense, may not look all that great. And then there is a hotel demerger ratio. My understanding of the hotel demerger ratio is that it's been done very thoughtfully, and it's been done thoughtfully because in this entire merger, new shares would be issued. If the new shares are being issued, that you have to ensure that, because after the issue of the new share, the total underlying value of the ITC hotel does not fall and does not become a penny stock. So there's a technical thought behind it, but it's a thoughtful thing. ITC, I think, has been in performing stock. So it is unlikely to see massive upgrades, but it is a stock where I think the terminal value versus the current market price, the upside is still visible in the medium term. I will not be surprised that post these numbers, the stock starts outperforming the FMCG basket. Look, it's not going to be a multi-bagger like it has been. But if you have to really look at the construct of the FMCG sector, large companies, I'm not talking about small companies here. You've got HUL where you know the numbers and margins and market share concerns. The best of the margin expansion is behind us. You come to Nestle. Nestle, for the quarter gone by, volume growth was a concern. Then you come to Marico, not big in terms of size. ITC FMCG business, I think, is growing and the margins are expanding. So within that cohort or within that ghetto of FMCG, I think ITC will outperform, and it has outperformed, continue to outperform. Now, I don't think it has got enough and more valuation to appeal that it will continue to outperform the Nifty now. It has been a Nifty outperformer. I think now it will be an FMCG sector outperformer.
And to the point that you were making on the demerger math as to how is it that they derive this 10:1 equation?
See, when the demerger happened, they'll have to issue fresh shares. If they would have issued fresh shares, the demerger would have been 1:1, then that would have led to a lot of dilution, which would have led to the price of ITC hotel come down to 9 to 10 rupees. My sense is it's been done because you want the underlying market, the price discovery, which should happen at a higher price. 5% is what you think is the FMCG value, is the hotel value. If this entire structure goes through and if the hotel sector is doing okay, I think the price discovery for the hotel stock, whenever it will list, I think it will be above 50 rupees, which I think could mean positive surprise in due course of time.
Okay.